It has always been among the goals of Berkshire Hathaway to maintain a strong financial position, end quote. Now, that may sound like maybe the most boring or the most obvious statement you've ever heard, but we're going to talk today about how that statement can change your life. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I am your host. And you may have noticed that between that cool hook statement that I began the podcast with and then the intro statement that I just used to intro the podcast, there was no cool music there. And I know that it's the cool thing in podcasts to have cool music, right? I'm all about cool music, but I am not a cool music guy. That's just not who I am. I'm not the guy to find the cool new songs. So here's the deal. I would love to have music on my podcast if it's awesome. If it's not awesome, I don't want to do it. Just like this podcast, if these episodes aren't awesome, I don't want to do them. And so that's why I love your feedback. And if any of you out there are music people and think, hey, this sound clip or this music would be awesome for the Invest in the Family podcast, shoot me an email at Brian, BRIAN, at investorinthefamily.com. And I would love to hear your thoughts because I would love to have great music on here, but I had some music before in the past that was okay, but I don't want to spend the time putting okay music in my podcast. There's that. So email me if you have ideas, Brian at investorinthefamily.com. But we're going to go ahead and jump into today's podcast. For those of you who are just joining us, this is officially week 2, not including the intro week, of our ongoing series of going through Warren Buffett's letters to shareholders of Berkshire Hathaway. And the whole idea behind this series, and a big major shift in the Invest in the Family podcast and the company Invest in the Family as well, is the idea that as we're continuing to figure out how can we become the best investors possible as we look to provide for our families financially. So everyone always gives lip service to Warren Buffett being this amazing investor, and obviously he is, and he's easily proven himself as an amazing investor. But what I find is while most people give lip service to how great he is, but I just don't see a lot of people actually following his methods and his footsteps because it takes discipline and hard work that a lot of people aren't willing to put forth. But I really believe that not so much hard work that most people can't do it. It's more the discipline and emotional factor that derails most of us. As Warren Buffett said in his intro to the book, The Intelligent Investor, written by Benjamin Graham, he talks about really the only thing necessary for us to find investing success is 1, have a competent plan, and then 2, stick to that plan. I believe we can all do that. I want to help all of us create an amazing plan and then have a community, an Investor in the Family community, help us stick to that plan so that we can find amazing investing success over time. And so my philosophy here is that we are all business owners. Any of us who have money to invest, that is a business. And we have a choice. Are we going to outsource that business to hire an outside manager to manage that business? And that's a perfectly acceptable option if you want to do that. Or do you want to manage it yourself, or somewhere in between? No matter where you are on that spectrum, you need to understand your business and how it works. And I want us to understand how investing works well. And I want to approach my investing with the philosophy that I am building my own personal Berkshire Hathaway. For those of you not familiar, Berkshire Hathaway is the name of Warren Buffett's company. And so I want to learn as much about Warren Buffett and how he manages his company as possible, and I want to try to follow in his footsteps as best as I can. Obviously, there are dramatically different positioning in terms of resources available at his disposal versus at my disposal, and I'm sure yours as well. But that doesn't mean we can't take what he's doing and scale it to where we are, and that's what we want to do. So last week we discussed the 1965 letter, and this week we're doing the 1966 letter. They're getting a little bit longer. Last week's letter was 1 page. This week's letter is about 4 pages, and I know they'll get longer as we move forward, which is great. More content and more goodness, hopefully. And so again, the core idea, I think, around today's content is the statement, it has always been among the goals of Berkshire Hathaway to maintain a strong financial position. We're going to talk about why that boring statement is so significant. And really, I want us to not make the mistake of degrading our situation with false mindsets that lead to us to any other kind of thinking that our financial situation is not important and is not serious. I think the commoditization of brokers and cheap brokers has made investing become like this really kind of cheap, easy thing that all of us can do whenever we want. We can pay $5 per trade, $8 per trade. We can buy and sell companies all day if we want to. And it makes it, I think it just cheapens the overall experience of investing and the idea of investing. Hey, I jump over here, read an article, then I jump over to my brokerage and I buy stock in that company. Then I regret it a week later, rinse and repeat, right? So that kind of makes investing is like this kind of cheap type idea. And honestly, I think in a lot of investing circles, the term personal finance almost seems kind of like it's just like really boring and like something you don't want to spend time with, because how boring is personal finance? That term just sounds so boring. But when you say corporate finance, it sounds amazing and has this air of grandeur to it. And I want to change all that. The only difference between corporate finance and personal finance is scale. Okay. And so to a corporation, my personal finances may mean nothing to them, but for me, it is my business. And your personal financial situation is a business. So let's view it that way, and do not make the mistake of letting the term personal finance sound boring or like a waste of time to you or anyone else, okay? The management of our personal finances is a business endeavor that must be taken seriously. And in Buffett's 1966 letter, and again, it's not signed by Buffett, but he's attributed as having written it, because it's still signed by the Chase family, who I think are the chairman of the board and the president, Malcolm Chase, and then Kenneth Chase. But so I think once that Warren Buffett and his company acquired Berkshire Hathaway, he started writing these letters, but they were still under the signed by the chairman and president of the company at that time. So just a little side note there, in case you're wondering, why in the world is Warren Buffett not signing these? He will eventually. And also this letter, I really feel like is what plants a seed for the birth of Berkshire Hathaway as we know it. Just go ahead and just jump into it. So I was really concerned when I first started reading this letter, because I thought, what on earth am I going to say in the podcast? Because it sounded really boring. And I was like, there is no amazing nugget of information here. I mean, I can always really extrapolate out of stuff, but I really don't want to have to do that if I can help it. So the first half of the letter is focusing on the operating conditions of Berkshire Hathaway. It talks about different sectors of the company that are underperforming, and so they had to shut them down, and other sectors that are facing some obstacles, so they've had to cut back production, and then other segments of the business where they've increased their expenditures to help develop them out even more. And so okay, that all sounds boring, and it is kind of boring, but it actually is really significant in realizing that when Warren Buffett came into Berkshire Hathaway, he cleaned house. He made sure to take time to put the Berkshire Hathaway's house in order. So there are parts of operations that he said, hey, we got to cut this out. There are other parts of operations that, hey, we need to scale this back. And other parts of operations where he said, hey, we need to really ramp this up even more. And that's going to be some of the big takeaways for us today, is us taking time to get our own personal house, our personal finances in order, so that we can set the stage to become successful investors over a lifetime. And I keep saying long-term and lifetime for a reason, because this is not a one day, 1 week, or 1 month journey, not even a 1 year journey that we're going down right now. And again, we look at Berkshire Hathaway and realize in a year, the first couple of years, it was a nothing company to the outside. Now it's a world-renowned company worth billions and billions and billions and billions and billions of dollars. So this episode is going to be about getting our own personal financial house in order. And again, we're going to jump into the last half of the letter under this section, maintenance of financial condition. And this is where I get to this point and I realize there is amazing, amazing gold in this letter for myself and hopefully you as well. And it begins with a simple statement. It has always been among the goals of Berkshire Hathaway to maintain a strong financial condition. Now that sounds like, well, of course, anyone wants to have a strong financial condition as a company or as a household. But here's the question is it really a goal for me? Is it really a goal for you? Is it really something that we work toward? And do we approach it, again, as we would a business? If we had a business, we would want to be very diligent to maintain the expenditures of that business, the costs of that business, the debt of that business, and the assets of that business. And, it wouldn't be something where we have, okay, we got some money over here, we got some money over there. I'm not really sure how much is in that account. I'm not really sure how much savings I have over here. There's not really any process for savings happening. And I don't really have much of a budget that I'm working with. So, and I'm going to go out on a limb and say that's most of us. And will be very insecure in saying that that's me more than I want to admit it. And that is shameful. That is shameful. Because if I am going to be honest with myself that my personal financial situation is my business, is a business to me, then my business is, it may be performing well because there's some sectors are doing really great and they're making up for the lack of attention in other areas, but that's still sloppy. And so just because maybe it's profitable right now, it doesn't mean that's not sloppy and doesn't mean I'm not being very irresponsible. And so let's dive into a couple of different ideas here. And then I want to discuss or share some ideas that I think all of us need to seriously consider as we look to getting our personal financial house in order to set the stage and foundation for being very successful investors over a lifetime. So I'm going to read a paragraph here from the section under maintenance of financial condition. It says, in addition to the cyclical nature of our business, there are other reasons why a strong financial condition is advisable. As you have been advised previously, the company, Berkshire Hathaway, has been searching for suitable acquisitions within and conceivably without the textile field. And in my opinion, that statement right there is planting the seeds for the company of Berkshire Hathaway that we now know today. People don't think of Berkshire Hathaway today as a textile company. They think of it as Warren Buffett's conglomerate, which owns over 50, almost 60 different companies underneath its wings. And here's this idea. Again, the company has been searching for suitable acquisitions within and conceivably without the textile field. So here's the mindset I want us to take from this, and then I'll keep reading. Okay, our personal financial situation is a business. So again, our income from our job, our any kind of debt we have, any kind of money we have in the bank, any kind of assets we have in our portfolios, all that is part of our business picture. And so as a business, we want to be have been a healthy standing, in the sense that we have more money coming in than's going out, and that we're saving money and we have a healthy cash position. We have healthy liquidity as a household. And then once our financial house is in order, we have this mindset. We want to begin searching for suitable acquisitions within and conceivably without the textile field. And so basically, we want to, as a household, once I get things in order, want to begin searching for suitable acquisitions. I mean, primarily outside in this case, my household. So the idea is that, so I want to start looking for ways I can use the money that I've been earning in my job or side jobs cumulatively, and then take that money and I want to make acquisitions elsewhere. So I want to start looking elsewhere to find great opportunities to allocate my capital. So let's say I've got $10,000 worth of savings that I've earned and saved for my job, and I've got an emergency fund set up of 3 to 6 months worth of income. So I have very healthy liquidity, and I have a very healthy approach toward any debt that I may have. And then beyond that, I want to say, okay, so now I'm making money beyond those base measures, and I want to use that money to make acquisitions elsewhere, to allocate elsewhere where I feel like I have the best. I want to allocate that capital in areas where I feel like I have the best opportunity for financial return. Okay. And again, you may be thinking, well, isn't that just what I'm doing with my personal investing? It is, but the mindset is radically different. And I want to be about shifting that mindset with this series. And so let's keep reading. It says, although to date, none has been successfully concluded. So he's saying right now, we have made no acquisitions internally or externally, but we continue to have an active interest in such acquisitions. The present state of the money market, in which funds are virtually unobtainable for acquisition purposes, radically different from our situation today where funds are readily available, makes it imperative that we have available the liquid assets with which to consummate such acquisitions. Should the hoped-for opportunities present themselves, present uncertainties such as war, tax rates, and decreased level of business activity also all combine to emphasize the continuing need for strong financial conditions. So what's he saying here? He's saying basically the current market means it's really hard to acquire funds. Basically, it's really hard to borrow money right now, or it's not really a good situation to borrow money. And again, he's talking about 1966, to borrow money to then to help fund an acquisition. So if that's not very available, and then on top of that, there's concerns about war, in that case, Vietnam, tax rates, kind of a depressed business activity or economy. So, and all that, he's like, basically, when opportunities present themselves, there's an environment that we're in right now that is not conducive for getting outside help to make an acquisition when the opportunity presents itself. So we have to have a strong financial condition so that when a hoped for opportunity, as he says, presents itself, we are able to act on it. Okay, so again, let's digest that a little bit. So it talks about, so when a hoped for opportunity presents itself, again, radically different mindset than almost any other DIY investor that I know. Again, we all have the idea that, hey, I've got money. Let's go find a place to spend it on, basically. Go find a place to invest it in, and we read articles that get us hyped up and excited about an opportunity of a company, and we jump into the company that may or may not be a good idea. And a radically different idea is what he's saying is, okay, so we want to make sure the company has a strong financial condition. And so we want to make sure our households have a strong financial condition. And as we have extra money to allocate, we want to be patient. And he says, so should hoped for opportunities present themselves, we have hoped for opportunities that we're waiting for, not jumping in trying to find today so I can feel excited about making a big return this year. The patience factor is crucial. So again, we need to have the mindset of, okay, now I have this extra capital that I can allocate. Let's start looking for opportunities and waiting for the right opportunities. Not jumping because I'm excited, not jumping because someone else is excited, but waiting for an opportunity that I can clearly say, this is a home run acquisition opportunity. And again, in our mindset, we may not be acquiring entire companies, and most likely we'll be, quote unquote, making acquisitions in the public markets, the stock market. So maybe we're buying just a handful of shares in a massive company or a small company, but even so, a handful of shares that no one will ever know that we own because it's such a small position to anyone besides us. But to us, it matters. And to us, I want us to have the mindset that we have just acquired that company. And I want to approach it with that level of seriousness as well. Okay, let's jump down to a few paragraphs down to another section that I want to read as well. And he says, however, should we decide that it is in our best interest to make capital expenditures, we must be in a financial position to do so. Sufficient working capital would be particularly necessary if the advent of important cost-cutting equipment coincided with a period of depressed textile earnings, making outside capital difficult or impossible to obtain. Again, it's probably a little wordy, maybe hard to get your mind around when you're listening to this as a podcast out there. But let me read it one more time. Should we decide that it is in our best interest to make capital expenditures, we must be in a financial position to do so. Sufficient working capital would be particularly necessary if the advent of important cost-cutting equipment coincided with a period of depressed textile earnings, making outside capital difficult or impossible to obtain. So basically, as we look to maintain healthy financial condition of our households, our business, then so a while ago, the paragraph I read was talking about mostly external acquisitions. This is talking about more internal capital expenditures. And so he's saying basically, there could be situations where we need to make internal capital expenditures. We need to spend money internally to build our business. But maybe our business will be slow that time and we won't have the extra income to do so. And applying this personally, what if we get a pay cut? What if we lose our jobs? What if we have some kind of or some kind of a personal situation in our personal financial situation that inhibits our income, we could say, or our financial situation? It says that is all the more reason why having a healthy, strong financial position is crucial. So again, that's the idea of having that healthy savings and all that kind of stuff, because you never know when you might lose your job. You never know when you may have some kind of a significant financial obstacle out there. So you want to make sure you're in a strong financial condition to be ready for that. And that even in that scenario, you're still liquid or nimble enough to be able to make internal capital expenditures within your household, within your personal finance business to continue to grow your company. And you think, well, what on earth does that have to do with me and my personal finance, my quote unquote business that I'm running, my Berkshire Hathaway that I'm building? It's like this. Because again, you are a business owner. I am a business owner, and we want to always allocate our capital in the direction that will help us get the greatest return in the long run. So that may mean making an external acquisition. That may mean making an investment in an outside company, or it may mean making more investment in ourselves. So for example, that may mean purchasing training that can help you increase your income. It may mean purchasing some kind of training or tools or resources that can help you start a side business to earn supplemental income and provide a new income stream for your family. Those are situations of internal capital expenditures that you want to be able to make when necessary. So it's something really important to think about. And then here's one of the last key paragraphs I want to read right toward the end of the letter. It says, because of uncertainties in knowing when the company, Berkshire Hathaway, may be called upon to produce substantial sums of cash, and the possibility that this might not occur for a considerable period of time. So basically saying, we don't know when Berkshire Hathaway may need a lot of cash for running operations. We don't know when that's going to happen. Or we don't know when there may be an internal need for significant capital investment or expenditures to internally build our business. We don't know when that'll come. So it says, in the possibility that this might not occur for a considerable period of time. So basically saying we don't want to sit on cash forever. Your directors have felt that we should be as zealous to achieve a realistic return on this portion of our capital as we are on the other funds that are at the time invested in plant, in inventories, in receivables, etc. So again, the idea is that as a company, they have capital to invest or allocate, I should say. And so they want to decide, okay, is this capital going to be more profitable to our company by allocating it internally, by sitting on it, or allocating it outside of Berkshire Hathaway? And he's saying that they think they want to start pursuing very zealously opportunities for allocating their capital outside of Berkshire Hathaway. And this is where I feel like he's planting the seeds for Berkshire Hathaway, the textile company, to become Berkshire Hathaway, the conglomerate that we know it to be today. Accordingly, back to the paragraph, it is the present intention of the directors to proceed toward the interim investment of a major portion of these funds in marketable common stocks. So Berkshire Hathaway did not get started by acquiring other companies outright, which is something obviously he's known for, the company's known for doing now because of their scale. But early, they weren't working on that scale. They weren't working on the scale of acquiring other companies entirely at that time. And so they started out by allocating capital into marketable common stocks. And this, he said, back to the paragraph, which is obviously like what we would be doing today for most of us. This should hold promise not only of greater income than can be achieved through alternative investment possibilities in the field of non-equity marketable securities, but also provides us with the opportunity to participate in earnings derived outside of our textile business, even if only temporarily and indirectly. Again, he's saying, if we find better opportunities for return on capital or a return on investment outside of Berkshire Hathaway, we're going to take advantage of them. Because bottom line is, we want to be great allocators of capital. And again, I want that to be our mindset as investors, as business owners. And again, I don't want to avoid the term DIY investor because that's 100% what we are. And I embrace that term. But I fear that for many of us, that term is very limiting as well. I want to use the term, we are business owners, okay? We are allocators of capital. I want to say we are private equity portfolio managers in a sense. The only difference is we're not necessarily investing in private companies yet, but actually we are a private company. So yeah, in that sense, we are private equity. We are investing equity in ourselves, and with extra capital, we may invest that in public equities, and in time, we may begin investing that in private equities. One of the things I want to start doing the show too is actually start exploring more opportunities like that as well, but we'll save that and not get into that right now. So again, just amazing things from this from this short letter written back in 1966. Another thing I want to bring up too is that when I went back to the chart at the beginning of the book where the author lays out basically all the different acquisitions that Berkshire Hathaway has made at the time, this book was published in 2014. At that time, that was 50 years of Berkshire Hathaway. Obviously, there have been a few more since then. But at that time, I went back and counted, there were about 59 different companies that were acquired during that time. And which is in 50 years, 59 companies in 50 years. Okay, again, how radically different of a mindset is that than we have, than most DIY investors have, at least in my experience. And so I want to think about, how does that compare to my portfolio and your portfolio? And highlighting the idea that they were not in a hurry to allocate capital. They were eager to do so as the right opportunities presented themselves. And when they did so, they were okay investing a lot in a few number of companies early on because they felt like the opportunity was there. And over time, they just keep adding to that. As they have more capital, they look for more opportunities to allocate that capital in other companies. And so I want to briefly introduce this idea that I'll get into a lot more in future episodes, I'm sure. I call it the entrepreneur to kind of purely passive investor spectrum. I actually wrote down the entrepreneur to the mutual fund of mutual funds continuum. So on one end, you've got an entrepreneur who 100% owns his company, has no employees. And so basically he is the person, or he or she is that person, and they're fully owned and they are fully responsible for all that company, right? And so they get all the good stuff and all the bad stuff. On the other end of that, you have someone who owns a portfolio that is basically full of mutual funds. And so you've got like 25 mutual funds or more in a portfolio, and all those mutual funds own 25 companies or more. So really, you're just a big index fund, which again, it's fine. That's fine. You need to do what you think is best for you and your family, what you're comfortable with. But that's kind of a spectrum I like to put out there. And where we land on that spectrum, in my opinion, a lot of it comes down to the amount of information that we have about that company and our risk tolerance, of course, as well. And so I'd say the less info we have, the more diversified we should be. And so if I'm an entrepreneur, I have 100% info on my company that can be known. Obviously, no one ever has 100% information because we never know. There's so many external environmental factors we can't control and internal factors we can't control. But as far as much as an investor can know, as an entrepreneur, I know all that someone can know about my company, right? So on the other end, as the mutual fund to mutual funds type idea, you basically know nothing about any of the companies because you're so diversified. You don't need to know about them because you are insulating yourself from any one company having an issue. And so the more you know, the more comfortable you can be sliding toward that entrepreneurial end. The less you know, the more it makes sense to slide toward that mutual fund to mutual funds type idea. And so as we're out there making investments and thinking about our portfolios, whether we're going to invest in one company or 25 companies or more or somewhere in between along there, I think it should really come down to the amount of time and energy that we can invest in understanding those companies and the amount of information we have, the amount of confidence we have in that investment that leads to conviction. So I like to say, knowledge and understanding equals conviction, and that equals a concentration of assets. Again, I'm not saying you should be concentrated in your assets. I'm saying that I think that's how my philosophy is toward it. And again, where you land on that is obviously 100% up to you. But we'd love to hear what you think about that, and we'd love to hear your thoughts on this episode. I've gotten numerous emails from you as listeners already excited about this series, give me feedback and thoughts on different ideas, and I love it. So email me, Brian, Brian, at investorinthefamily.com. Would love to hear from you, any ideas on this podcast or otherwise. And I'm stoked about this series. This is the 1966 letter, and I hope you enjoyed it as well. Have a great day. I'll talk to you soon. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.